Hi, this is Bob Iaccino talking S&P futures from the CME Group trading floor in Chicago. New record again today, new record high in the S&P. We seem to be making a habit of this, but today was a very low volume day, and we were virtually unchanged in terms of change on the day. We were up 9/10, not even 9/10, less than 1/10 of 1% on the S&P and toward the close. Very low volume, and a little bit of that rally still dependent on the hope of tax cuts. The only real hope of tax cuts right now, unless something changes just the way it sits today, is that if the Republicans don't get something across the finish line by 2018 midterms, they have nothing to go to the voters with to show that they achieved anything, and it could be disaster for Republicans in the midterm elections. That's what analysts are saying about that, and that's why some tax reform and tax cut hope still remains, pushing the S&P a little bit higher on a day where there's nothing else really going on. Now, we are looking at getting some earnings clarity this week, specifically in the financial sector. Bank earnings have been mixed. We saw Bank of America do well. We saw Wells Fargo get hit pretty bad. We saw Citi get hit pretty bad. And this week we got Morgan Stanley and Goldman Sachs. So with these particular behemoths releasing their earnings, we could get a better picture of the way earnings look for the best performing sector of the year, which is the financial sector. That's the kind of clarity we're looking for in the short term. There's many other companies releasing this week, but the financial sector really needs that boost in order to continue to help the markets chug along to new highs with some volume this time. We also had some Janet Yellen comments over the weekend that were interesting in terms of their effect on the equity market. They didn't really move it, but Janet Yellen told people at a conference over the weekend, told attendees at this conference, that she thinks slow inflation data will not persist. She feels soft, rather, inflation data will not persist, not slow, soft data. So if that soft data is not going to persist, then obviously the Fed's serious about rate hikes. Now, I feel we already know that the Fed is serious about doing more than just the December rate hike. That is all but assured. If you take the word of Bill Gross, it's a slam dunk. But are they going to do more than that? And it's looking like she's trying to portray to the markets that this soft patch of inflation data, even though it's rallying up a little from where it was, is still transitory. Now, we found out last week that some other members of the FOMC did not agree that it was transitory. They feel that it's something that's more structural, okay, something that's going along with the tech revolution and things like people using companies like Amazon and things like that, disruptors, so to speak. Yellen doesn't seem to believe that. So that's one of the larger risks to the market, more so than earnings. We need earnings to be strong because the Fed is tightening rates into a low inflation environment. So in order to keep these valuations and chug the market higher, we are going to need strong earnings. We're going to get some of that earnings clarity this week. This is Bob Iaccino talking S&P futures from the CME Group trading floor in Chicago.